Hey traders, as you can see, I'm in a room, but I'm also in England, jolly old England, and took this footage today, walking around. I wanted to just talk about something that is, I think I mentioned last week, that is something that's going to affect the world, and again, I use this term a lot. The UK is the canary in the coal mine, and this is the pension system. Pension systems around the world are broken, and the first ones to break here are the UK. In the UK, again, around the world, pensions have been forced to invest in very low-yielding bonds as the governments, along with their close allies, the central banks, which, by the way, are not independent, decided that they don't want business cycles anymore. So what did they do? They just lowered rates to zero. That was their intention. In some cases, like the EU, it happened fast. Some cases, like the US, it took a while, but everyone went to zero. And you heard people say, oh, it's going to be zero for a while. It makes sense, blah, blah, blah. Poppycock. It was artificial. Never should have happened. And now we're seeing the results. We're seeing a disaster in the making. And it's not going to end. So here, who are the biggest problems? The biggest problems are in pension funds. And we're seeing it here in the UK with a strategy called liquidity-driven investing. Okay, ridiculous. LDI, liquidity-driven investing. This was something invented by the investment banks, by the Credit Suisse, by the Goldman Sachs, by the Morgan Stanley. Basically what they tell you is, okay, you have pension funds have assets and liabilities. Their liabilities are what they must pay out to the people, to the pensioners. Their assets are investments. And when rates are going to zero, the pensions get crazy because they don't have enough of this money to pay out to pensioners. They don't have enough income. So the investment banks decided that, hey, they're going to put together these derivative products, and what they're going to basically do is help you build up your assets to pay off your liabilities by using derivatives, by basically leveraging the fact that in their mind, bonds will be low forever. Don't have to worry about bonds reversing. You just hold on to this. We're going to increase your leverage. You'll be able to pay out your pensioners. Everything's going to be good. Again, this was ridiculous, made no sense. The pension funds bought it. They not only bought this kind of derivatives, they also bought tons of bonds at below 1%. In the case of Europe, negative rates. So what happens when we finally break out of this and go to normalized interest rates, because inflation is going through the roof? And by the way, don't blame Ukraine. This is monetary inflation. This is inflation caused by central banks and, more importantly, governments who don't want business cycles. So what happens now? Rates are going up drastically. No way to hedge. No way to move. Rates are spiking up. So if you're 6-7 times levered like every pension fund in the UK, and you've got these LDI, liquidity-driven investments, all of a sudden the bonds are going against you. And you got these brokers, they're holding it on their balance sheet, and they're saying, oh, okay, well, you're levered 6 times, the bonds just went up 100 basis points, or almost 100% up from where they were, or 50%, whatever it is, we need you to put up more collateral. And the pension funds are saying, going back and saying, we have no collateral to put up. So what do the banks do? They have to liquidate. And if they liquidate, they destroy the asset side of the equation, leaving the pensioners basically on the hook. Well, fortunately for pensioners, governments will never let this happen. They'll always intervene. But the bottom line is, this LDI, this liquidity-driven investment, this caused major problems. Okay, forget about what the MP or forget about what the government of the UK did with the taxes. That's small potatoes. What really caused this volatility was this LDI, and this is going to have major implications going forward. But it's not unique. Again, the UK is the canary in the coal mine. Think about it. Every pension fund around the world over the last 10 years has been averaging down their rates. They've been buying rates into the zero environment. So if you have zero rates, and all of a sudden your 2-year bonds, your 5-year bonds, your 10-year bonds come due, and next thing you know, you've got issues, right? You've got to deal with it. And if you've been buying 10-year bonds or 20-year bonds into declining rates, you've got massive volatility and massive paper losses. If you're levered and your bank's holding it as collateral, they're going to say to you, hey, put up more collateral. So I would suspect that what we're seeing in the UK is going to happen all over the world. The U.S. is not immune. U.S. pension funds got sucked into this as well. I don't know. We haven't seen anything yet, But it's inevitable. You're going to see this in the U.S. You're going to see this all over the world. These pension funds, and also insurance companies are going to have some major issues because, again, rates, the dollar is causing massive, massive dislocation and massive volatility. So again, the dollar, interest rates, the central banks being behind the curve or clueless, which in the case of the U.S. they're clueless, and then the governments, the White House and all the other governments, and I say the White House because I blame the previous administration, the previous administration before that, all of these governments over the last, let's say, 15 years, or really over the last 10 years, have decided they do not want business cycles. So what do? They lower rates when they don't have to. They lower rates to zero. They don't want downturns in the economy. Absolutely ridiculous. And we are now we're living through, and this is just the beginning. Remember, it's only been 6 months since rates started going up, and rates are going to go higher, despite what everyone says. Rates are going to go higher. Inflation is very sticky. Okay, inflation is very sticky. These oil prices, they came down, they went up, they came down, they're going to go back up again for a lot of different reasons, and you'll see that in the future. But the bottom line is, if you've been paying attention to the LDI, to the UK problem, liquidity-driven investing by pension funds, I guarantee this is not the last you're going to hear about pension funds in trouble around the world. How do you protect from it? You go to cash. Okay? Cash is king right now. You're going to be able to get 3% and eventually 4% by first quarter next year on your cash. Why wouldn't you want, or even 2-year piece of paper, 4%? Why wouldn't you want to sit at 4% and just sit out this volatility for a while? Because it's going to be with us for quite some time. I don't care about this rumors of Fed pivot and all this nonsense. We're about to enter a very destructive earnings season in the U.S. It's going to carry on all over the world. Again, we're in a global situation. China's got major problems. They're coming into their big annual meetings. There's going to be some volatility there. So cash is king. Okay, don't listen to anybody. Cash is king. Tina, there's no alternative. That's gone. Tina's gone. Put it in a bag. Throw it in the river. It's gone forever. There's a lot of alternatives now. So the stock market is done. Okay, for the short term, it is done. You're going to have opportunities in different sectors, and also individual stocks. So forget about indexes. Forget about ETFs. All of that. Get out of it. Find good companies and invest in them. That's the bottom line. So again, from the UK, from the beautiful UK, happy trading.